Hello and welcome to today's lesson on inventory write-down. So what we will be working through is you're going to be introduced to a new term, net realizable value, and you should be able to explain what that means and also calculate it. You'll have to identify direct selling costs, which will help in your calculation of net realizable value. Once you've found NRV, you'll be able to calculate, if applicable, the amount of an inventory write-down, and then record it in our inventory card general journal, and then post it to the general ledger. So this is the key knowledge from your study design that it links to. So inventory valuation is the lower of cost and NRV rule, and then posting an inventory write-down in the journal, ledger, and the inventory cards. So firstly, what we've learned so far is inventory is valued at its cost price. So this is important because the cost price is verifiable. It's exactly what is on the supplier's invoice, and it provides a faithful representation of the business's inventory. It's neutral and free from error and bias because we can verify it to the supplier's invoice, the source document. As we learnt last lesson, cost price includes all product costs, and that's costs that get the inventory in a condition or location ready for sale that can be reasonably allocated to individual items of inventory. So we carry inventory at cost price. However, in the world of business, sometimes an item of inventory or a line of inventory will fall below the cost price. So this could be because it's been damaged, and we may need to discount that damaged inventory to sell it. The business may also have a promotion. So some businesses will deliberately sell certain lines of inventory below cost price to try to get people into the store to pick up the bargain, and while they're in the shop buying the perceived cheap goods, they will also purchase other goods that the business is making quite a high margin on. So it may be a promotional tool. It could just be a decrease in demand. People no longer want the product at the current market price, so to get rid of it, businesses will discount it, and to counter the fact that the demand for the good has decreased. And lastly, the good may become obsolete. It may be superseded by new models, which probably links to the decrease in demand as well. So they are all reasons why inventory may fall below cost price. So here we are going to be introduced to our inventory valuation rule and also a new term. So the rule is we must value inventory at the lower of cost and net realizable value. So whichever of these two is lower is how we need to value our inventory. So the question is, what does net realizable value mean? So net realizable value is our estimated selling price, what we think we'll sell the inventory for, minus any direct selling expenses. So these are any expenses incurred sell the inventory. So it might be things like marketing, distribution costs. The business might even throw in free gifts when the inventory is sold, which would itself be a direct selling expense. So as you're introduced to questions, direct selling expenses will hopefully become quite clear what they are and what they aren't. So let's have a look at an example here of an inventory write down. So spend some time now having a read of the scenario. You can pause your video if you want, and I will talk about how we'd approach this from an inventory write down perspective. So first thing to notice is what is the cost price of the inventory. So the cost price, we have 6 dishwashers and they cost us $500 each. So that's the cost price, $500. Currently, they're being sold for 650 plus GST. So the net realizable value is higher than the cost price. So we're valuing it at the cost price because it's lower. However, at the end of August, a new model has been released, and to get rid of this older model, the business has decided to discount it, but also implement a special advertising campaign. So we have here 550 is our new estimated selling price, which is still above the cost price of 500. However, we have this marketing campaign, a direct selling expense of $720, and 720 divided by 6, the 6 dishwashers that we do have means that each dishwasher has a direct selling expense of $120. So the NRV of this good will be our estimated selling price of $550 minus our direct selling expense, the marketing campaign, which means our NRV is $430. Cost price equals 500. So our rule states we have to value our inventory at the lower of these two. So our 430, our net realizable value, is how we must value this inventory now. So what does that mean? That means we need to record the inventory write down in our inventory card and also in our general journal and general ledger. So let's have a look how we will approach this in the inventory card. So we still have 6 items of inventory of our dishwashers. So that's not going to change, but we record the transaction in the out column to decrease the value. So let's make sure, let's put the date in of the transaction, August 31. The source document is memo 31. Even though we don't have them physically leaving, we have some value leaving. So 6 are going out, and we need to decrease each dishwasher by $70 to get us down to the $430 net realizable value. So the total write down of inventory is going to be 420, which will leave us with 6 units with a value or a net realizable value of $430, and the total value of inventory, 6 multiplied by 430 is 2580. So we have recorded our inventory write down in our inventory card. Let's transfer it to the general journal. So again, 31 August, date of the transaction. Now we have a new account, new expense account, inventory write down. And the total amount we've written inventory down is this 420. So we debit to recognize the expense, $420, and we credit our inventory account because that has decreased in value. I won't write a narration today, but if you're asked for a narration, you'll have to write one and include the source document. So we've recorded it in our general journal. Now let's post this to our general ledger. So our inventory account, we have credited inventory. So 31 of August, cross-reference was inventory write down for 420, and our inventory write down we have debited, our cross-reference being inventory for 420. So that is how you record an inventory write down in your inventory card, your general journal, and then post it to your general ledger. So hopefully after this video, you are able to use estimated selling price minus direct selling expenses to calculate net realizable value, identify the type of costs that will be direct selling costs, calculate the inventory write down, which is what we need to lower our inventory to get down to our net realizable value, and then record it in each of these places. All right, that's all for today. Look after yourselves. Goodbye.